All eyes were on the non-farm payroll data revealed a minor slowdown in US job growth for June and rise in the unemployment rate. The Euro's outlook remains uncertain amid political developments in France. Polls suggest that a coalition government is likely, with a left-wing New Popular Front led by Jean-Luc Mélenchon gaining the upper hand. President Macron's centrist alliance follows alongside with Marine Le Pen's far-right national rally. Hi everyone, I'm Roy Güllüoğlu. Welcome to the another episode of Market Update featuring by Marketsall and Rationale. In today's episode, we're evaluating the market sentiment after the non-farm payroll data and the impact of political developments across the Eurozone on prices. Before we get started, make sure to subscribe to the channel, and if you find the video helpful, please give it a thumbs up. Also, if you have questions, please leave as a comment to the video. We will be glad to answer. So let's start with the economic calendar. So we had started last week with higher than expected JOLTS job opening number, which is in line with the idea of disrupted economic activity. As you can see here, it came 8.14 million and the forecast was 7.96 million, and the previous number was like 7.9 million. As a leading indicator of non-farm payroll, on Tuesday we received ADP, like a private sector employment non-farm data that came lower than expected and slightly lower than the previous one. And then we received both like a PMI numbers, service PMI numbers. Both PMIs aim to provide a snapshot of the US economy by surveying private businesses, but they use different methodologies. These PMIs are diffusion indices, meaning they measure direction rather than magnitudes. A reading over 50 suggests economic expansion, while below 50 indicates a contraction. This method is straightforward and gives an early indicator of more official data, but it has its limitations. For example, if one company lays off 1,000 people while two others each hire one person, okay, the PMI might show expansion despite a net job loss. So the S&P global PMI, also known as the market index, surveys around 1,200 US companies, including businesses of all sizes. In contrast, the ISM PMI surveys about 800 companies with a bias towards larger firms since it is sent to ISM members. So both PMIs have separate indices for manufacturing and services. This distinction is crucial today because the service sector has been a major driver of the inflation lately. Also, the ISM survey covers all service businesses, including like agriculture, retail sales, utilities, construction. That this situation make it more sensitive to the commodity prices and less sensitive to private sector downturns. Understanding these little nuances can help you better interpret economic trends and make more informed decision. So last week we had higher S&P service PMI in contrast to ISM service number. Personally, I prefer the ISM over S&P a little bit, let's say, in order to evaluate the current circumstance of the economic activity in high level, as it covers more like a general, like in more high level, because it's the way that you can spot mass layoffs. That's why it seems crucial to me. Yeah. So also we received the US factory orders. Declining factory orders also contributing to the theme of disruption in the economic activity. We saw the impact of all these on Atlanta Fed GDPNow model as a revision in growth expectation. As you can see here, this is the website of the Atlanta Federal Reserve Bank, and they have a GDPNow model. It estimates it's now casting the GDP actually, and as you can see here, just give me a second, please. Yeah, sorry. As you can see, it's revised to 1.5% on July 3rd, down from 1.7%. As you can see, what's the date of the July 3rd? All the dates, the date that we received all FOMC meeting minutes, ISM numbers, S&P PMI, and etc. So yeah, the ISM service data, ongoing unemployment claims, ADP number, combining all Atlanta Fed's revision, combining all these, this situation has strengthened expectation of interest rate cuts, leading to buying in the bond market. When we check the US 10-year yield at July 3rd, as you can see, this is the day of July 3rd, we saw like 1.78% decline in US 10-year yield. And yeah, so on Friday, the US dollar, like the Friday was the, as you can see, we received like a non-farm data, and it was the highlight of the week. The USD weakened following the release of the data as a slight slowdown in US job growth for June and the rise in the unemployment rate. This has increased market expectation that Fed might start cutting rates in September. Non-farm payrolls grew like by 206K last month, and the forecast was 190K. The private sector employment was only 136K, and the rest was like the government sector accounted for around 70K increase. Like health and social assistance is 82.4K. After that, the government side's coming. That means this situation like would push Fed to shift their focus from the headline number to private sector employment. Another crucial part is revisions that were done on April and May numbers. Those are pretty remarkable as well. And as you can see here, so this number is revised two times after the first preliminary one. As you can see, June number is 206. The May number had come 272, and this month it got revised to 218. The revision is 54K. April number got back to, after the third revision, 108. Yeah, as you can see, it's like it's 2 month non-farm payroll also keep revising down. So another important indicator is called like a temporary help services. It's important because temporary help services is known as like a third-party help, and if we see an increase in temporary help services, that means there is a firm, like a strong demand in the economy. But if we don't see, that means, just you can think about yourself. If there is a huge demand in your business and it's difficult for you to compensate with your existing sources, as you would ask for like a third-party help, right? And that would increase. That's kind of indication of a demand drop. That's the mentality. Apart from that, we received average hourly earnings. Average hourly earnings also declining, as you can see. It was previous number 4.1 and the current number is 3.8. Also monthly from 0.4 to 0.3. The participation rate has increased from 62.5 to 62.6. It's not huge, but it's something because it's pretty important. That aligns with the Fed's goals. As you might all recall, after the COVID period, Fed complaining about the participation of the lack of labor supply, the demand of labor and labor supply and labor demand difference was so high, and they were expecting to close that gap. With that closing gap, that means why they were looking for such thing. because higher participation rates reduce wages and reduce inflation risk. That's the path of like fighting with the inflation. And seeing these kind of numbers means that evidence of progress actually. Also, the unemployment rate came 4.41%, higher than expected 4%. It's a slight increase, but why this number is important? Because it's now with 4.1%, it exceeds the Fed's June year-end projection of 4% unemployment rate. That means that since their year-end projection, they wouldn't mismatch with their projections. That's why that means they might be much more eager to cut rates. With that mentality, that's the important part about the unemployment rate. So the overall assessment should lie around a soft landing, hard landing part. While economic deterioration calls for rate cuts, a severe recession could lead to selling in risky assets. Thus, the impact of economic decline on pricing will depend on how disruptive it is. Simply expecting rate cuts and buying risky assets may not be a viable strategy, at least in the short term. It should be important to assess how disruptive will this recession or distortion in economic activity will be. Because generally, when the rates are down, that means through discounted cash flow model, the forecasters about equity prices, generally they use their model with that interest rate as a benchmark rate. And when it's down, and when they discount the future cash flow with that low rate, that means higher equity prices. That's the mentality why low rate with high equity prices. Apart from that, low rate means low real rates. That's why investors seek for better alternatives. That's two-way mentality. So with that mentality, it might work. It's been working. But the thing is, if on one hand we have low rates, and on one hand if we have a hard landing, that might be risky. But in that case, maybe rather than selling in risky assets by all sectors, maybe we can see some sector rotation from to more defensive sectors consumer staples or healthcare sector and etc. So apart from a US side, French President Macron's decision to call a legislative election after the right-wing National Rally success in European Parliament contest did not lead to a new far-right government. The election resulted in a near three-way tie, with the left-wing New Popular Front has securing 180 seats, Macron's party dropping to 162, and Le Pen's party is 143 seats. No party achieved the 282 seats needed for majority in National Assembly. Since no party will ally with Le Pen's party, this is politics for sure, but that's the probability actually. The next government will likely be formed by a left of center force and also the market response was actually calm after the election, with minor recoveries only happening in French stocks and French bond spread. As you might recall, just after this emergency election call, the spread between German yields and French yields went so high, and those are recovering a bit. But overall sentiment still remains negative, reflecting that the election may have been better left uncalled, because it's currently in all coalition governments there's an uncertainty, and the market does not like uncertainty. On the pound side, British pound side, it has been rising since last week's Labour Party victory, which secured an absolute majority and brought political stability to UK. It's boosting financial markets. However, significant uncertainty remains regarding the Bank of England's interest rate outlook, despite all annual headline inflation returning to the target rate of 2%. Financial markets currently estimate 50% chance that Bank of England will start reducing interest rate at the August meeting. On the Australia side, Aussie remains supported by RBA's Reserve Bank of Australia's hawkish sentiment and hawkish stance and strong economic data reported last week. Also, market attention is now focused on Jay Powell's upcoming testimony before the U.S. Congress. So overall, while major events appear to have been avoided in France, like nothing big happened after all, after that spreads went high and stuff, uncertainty persists in Eurozone. Conversely, with the Labour's victory, in the Labour's Party victory, the UK promises political stability, which is positive for GBP. In this context, cross-FX strategies, like what does cross-FX mean? Euro GBP, Euro Aussie, Aussie Yen, AUD Yen. So all these cross-FX trade strategy might be worth considering. And before getting to those cross trade ideas, I would like to go through, as usual, from rates to these major instruments. First of all, this is again a 3-month SOFR futures. That means inverse yield chart. You can inverse yields rather than looking 2-year yields chart. I rather to check this one to see where the short-term yields are going. As we see an increase from here, that means yields are coming down. Okay, that's the mentality. So there was a symmetrical triangle, and I had mentioned in my previous 2 videos that I was expecting a breakout from this symmetrical triangle. It happened, and it got rejected from the minor resistance, and it is pretty normal in symmetrical triangle to see a rejection from the just previous high, and it is possible to see some pullback around here to trend line, and I'll be monitoring if the trend is going to resume or not towards 200-day moving average of this red line. Apart from this DXY, I would like to go through from the monthly chart. Look, in the monthly, when you go to the high level, it's the picture. Look at this, how clear it is. In the monthly chart, there's a really nice rectangle chart pattern. It got broke out, then it pulled back and still consolidating here. To see much clearer, let's go to the weekly chart pattern. In the weekly chart pattern, this consolidation is reflecting as a symmetrical triangle chart pattern just after a downtrend. A symmetrical triangle chart pattern acts both direction after a downtrend. It might act, if it goes up, that means it acts as a reversal, and if it goes down, that it acts as a continuation. In the macro level, it's so difficult to do forecast estimation. That's why I utilize technical analysis, chart pattern, classical chart patterns. And if it goes up here, then that means up above 106 levels, above these levels, 106.20 levels. Those areas might be risky for to increase exposure, especially in the risky assets. But yeah, I keep monitoring this like this. That's the way I'm monitoring. And in the Bitcoin, we saw a huge breakdown in this symmetrical triangle chart pattern. But at the same time, I don't want to say it's a huge breakdown, but after a breakdown, the second day of the breakdown, we saw a huge reaction from bulls. And the only negative side that I've seen, since it got broke down from a symmetrical triangle, but it got broke down to below 200-day moving average, which is a trend line for me. That's the risky part about Bitcoin, but it's now pulling back to the trend line. Let's see if it managed to go back to this trend line, and if it managed to go back above 200-day moving average. And while speaking of the cross that I mentioned, let me show you an idea. For example, Euro Aussie, for example. As you can see, after a huge uptrend, there's a really nice descending triangle. It got broke down. it's below all like a short-term moving averages, long-term moving averages. That means if you want to bet on this one to shorting this pair, means you're betting on weakening euro and strengthening OC. And as I mentioned just before, before, like Aussie is still like RBA is still persisting like on their like hawkish sentiment, while there's a like a huge political still risk on the table, sourced by France in Eurozone. And if you want to act on this one, shorting Euro OC might be a good option. And any pullback towards this 1.6061 levels might be evaluated as a short opportunity. And apart from that, about gold, nothing has changed from last week actually. With the non-farm payroll and seeing a distortion in the economic activity last week, we saw this movement. We saw this movement. And the topic of last week actually, the distortion in economic activity, it was at the beginning of the week, and after that we received all data that leads to all these price actions. And on Monday we saw some like a profit taking activity. But yeah, I don't know which direction will this. I mean I have a guess for sure about gold, but yeah, in either direction I will be monitoring this rectangle chart pattern. And yeah, that's all I'm gonna tell you this week. I hope you find the information valuable. If you enjoyed what you watched, please consider subscribing to our channel for more content like this. And please don't forget to hit the like button. And thank you for watching. We will see you in the next one. Have a great one.